Perfect. Hey guys, welcome to the next MedicareSchool.com live event. I know generally you're used to seeing Josh sitting in here, but I'm taking over for him since he's on vacation. My name is Garrett McKenzie. I'm one of the managers here. Just popping in to help out here. So kind of what we're going to do is obviously Marvin's going to kind of take it away here first, and we're going to talk about the IRMAs, kind of what it looks like for Part B of Medicare, kind of get but maybe a sneak peek, kind of what next year may look like for us. And then essentially what we're going to do is just kind of go through questions, and we're just going to answer them just top to bottom as they come in. So essentially, kind of what we'll do here is I'm going to let Marvin take over, and if you guys want to fill your questions here in the meantime, that would be great. Just kind of start filling those in. Like I said, we'll go top to bottom. So Marvin, turn to you.
Good. Well, Garrett, it's good to do this with you. We've done a few of these, and it's always been Joshua, my son, who's been at my side. But Josh is in Canada right now on vacation, probably working vacation. But just a little bit of word about Garrett. Garrett was one of our Medicare guides for a couple years, top notch. And we promoted him to be one of our managers, and he leads a team of 20. Does a great job.
Appreciate that.
Man of integrity, and just a joy to be around. So I'm glad we could do this together. So let's talk about the question at hand, and that is about IRMAs. Let's kind of remind everyone, those of you that are new to Medicare, this may be new information, but Medicare Part A is, for 99% of all people, is zero premium. And the reason for that is because we pay Medicare taxes all of our life. Those are called FICA taxes or self-employment taxes. So because we fund Medicare throughout our working years, Medicare decided when they began back in 1965 that there would be a zero premium for Medicare A. But there's always been a premium for Medicare B. And so the B premium is not free unless, of course, your low income, low assets qualify for Medicaid. Then the state Medicaid offices will oftentimes either cover your Part B premium in full or partially. But the majority of people are not going to get Medicare B for free. There is a premium. And that does change year to year. That premium is established by Medicare, approved, of course, by Congress. And so the premium this year for the majority of people for Part B is $164.90. Now, today is September 13th, 2023, so that is the premium. We are expecting that we are going to see an increase. Medicare actually put a report out in March speculating what the 2024 premium would be, and they were talking about going up $9.90, almost $10. But I think it was in July, they approved a new Alzheimer's medication, the FDA did, called Leqembi, Leqembi, that they think is going to be highly popular and effective. And so because of the expense of Leqembi, they believe we're probably going to see another $5 a month increase in the Part B premium. So we're expecting that to go up about $15. So that's going to put us right about $180, maybe $179.80, something like that, but we expect it to go up. And that is the premium that the majority of people pay, but it is based upon income. And the income specifically for Part B premium is called Modified Adjusted Gross Income, MAGI. And when someone's on Medicare, their MAGI that is used to determine their Part B premium is 2 years previous. So anyone that's on Medicare this year, 2023, it's their 2021 Modified Adjusted Gross Income that established their Part B premium. And so what we have in the Medicare system are thresholds. These are income thresholds that are established. And by the way, we think these will go up a little bit next year as well. But right now, if we have a single filer that is making $97,000 or less modified adjusted gross income, they're paying the base Medicare premium, $164.90. A couple that files a joint return, not a couple that files a separate return, but a married couple filing a joint return, that number is $194,000 or less. We're going to pay the $164.90. And for those of you that are not yet on Medicare, when you go on Medicare, if you're on Social Security, they actually take the Part B premium right out of your Social Security check. If you're not on Social Security, they will bill you quarterly, or you can set up some kind of auto pay through the Medicare system. But for people that are above those thresholds,
Hear us there, guys?
Yeah, will someone let us know if you can hear us? Okay, we are.
Anything yet? You're back.
Okay, all right, very good. Okay, so we'll go back. I'm not sure when we lost it, but I was
lost. It's a lost
high
audio
income.
after high income.
Okay, so what we're talking about was, Daniel, can you tell how far back I need? At the threshold or below, then we do not have an IRMA. Those thresholds right now for single filers, 97,000 modified adjusted gross income, and for a married couple filing a joint return. And I emphasize that because there are sometimes married couples file a separate return, and so that's a whole different level of IRMAs. I'm not going to get into that. So I'm talking about single filers or married filing a joint return. Single, 97,000 or less. Married filing a joint return, 194,000 or less. You will not have an IRMA. You will just pay the base Medicare premium, which this year is $164.90 a month. Comes out of your Social Security check, or they'll bill you quarterly, so it'd be times 3, or you can set up a bank draft. But if we're above 97,000 as a single filer, or above 194 as a married filer, we're going to pay an additional amount, and that's where we get the acronym IRMA. It's an acronym IRMAA, which stands for Income Related Monthly Adjusted Amount. Now, just real briefly, when you are establishing or trying to arrive at, do I have an IRMA or not, and you talk about your modified adjusted gross income, it's real easy to calculate. You go to your tax return, the 1040, it's going to be line 11, which is the adjusted gross income, and then line 2A. So you take line 11, add line 2A back into it, and that gives you the number that the government's going to look at to establish your Part B premium. So if I'm on Medicare in 2023, they looked at my MAGI in 2021. As we roll into 2024, they're going to automatically look back at 2022. They always look back 2 years. So if I'm a single filer above 97,000, a married couple above 194, I am going to have an additional amount for Medicare B as well as Medicare D. So you'll have both of these. And so right now I'm just going to talk about the first level, because there's 5 levels. The first level, IRMA, is $65.90 on the B, $12.20 on the D. And so that would put us in an IRMA right at $80 a month extra. And now the highest IRMA level, and this would be for single filers above 500,000, married filing a joint return above 750. That combined IRMA B and D is going to be right at $480 additional amount. So the lowest IRMA is $80. The highest IRMA is going to be about $480. And again, that's on top of your Medicare Part B premiums. All right, and so that's how they're calculated. Now, it is not uncommon for people that are high income that sometimes when they retire or semi-retire, they see their income levels go down, sometimes drastically. And so I want to make sure everyone knows that the government automatically looks back 2 years. So let's say I'm starting in 2023 and they're looking at 2021, but I retired this year, or I semi-retired this year. Then what can happen, I can actually appeal the IRMA. Now the form that we use is a form, it's 44, form 44. It's an SSA-44 form, and it's your opportunity to be able to appeal the IRMA. And when we appeal the IRMA, basically what we're saying is, I've had one of these life-changing events. We're going to talk about them. There's 8 of them. I've had one of those that have occurred in the last 2 years. And I don't want you to look at 2 years back. I want you to look either at 1 year back, or I want to give you my projection for the current year. And the government is happy for you to appeal. And honestly, I've never seen anyone lose an appeal as long as the information they provided was accurate and we're within the timeline where we can actually appeal. And we can use the same life-changing event. We can actually use it for 2 years. Since the government looks back 2 years, you can use your appeal date 2 years. And so we appeal the IRMA. And now sometimes I've had people, Garrett, where they were really high income and we didn't go all the way down to zero IRMA, but we reduced the level, maybe 2 or 3 levels. And so it is well worth your time to appeal an IRMA if you see an adjustment in that modified adjusted gross income. So let's clarify real quickly. the reasons how, or the reasons why we can appeal an IRMA. The first one on the list is marriage. In fact, I had this happen just recently. I had a lady that was single. As a single filer, looking at the single numbers, 97,000 or less, she was above that, so she had an IRMA. But she got married, and together they were below the married threshold. So we appealed the IRMA. We put in the marriage date. We had to have a copy of the marriage license that was submitted to the local Social Security office, and her IRMA was approved. And so actually they dropped off her IRMA totally. All right, that's one. That's marriage. Divorce. So it could be that together as a couple, you're high income, you divorce, and now less. And so as a couple, you had an IRMA, but now as a single person, you're below that threshold. And so then you appeal. What do? We fill out the paperwork, we put the divorce date down, and we have to supply a divorce decree to prove that. Then we have the death of a spouse. Obviously, that's going to affect income, especially if the spouse who died was the higher earner. Then you have a death certificate, a date of the death, and submit the paperwork. You'll win the appeal. We have work stoppage, no longer working, work reduction. You reduced your hours. And folks, I've had people who just reduce their hours by 10 hours a week. The government doesn't say how much you have reduced your hours, but you are now working less, therefore you're making less money. And so we would say, here's the date we began to make less money, we semi-retired, give them our projected number, and we will win the appeal. I'm going to mention just the others real quickly. One of them that throws a lot of people off on the form is called the loss of income producing property. Loss of income producing property. Now, that doesn't mean that you had an income-producing property that you sold and took a loss on it. What that means is that income-producing property is no longer around. It burned in a fire. It was in California. There was a mudslide. It is gone. You have lost the ability to make money off of that, and that's what's caused a reduction in your income. So that's pretty extreme, but that's one. In the loss of pension income, that means that you were getting a pension and the pension plan went belly up, no longer around to give you that money, and that's obviously affected your income. And then employer settlement payment, and again, that's no longer paying out. You've lost that income. So we have 8 life-changing events, and we can use these 2 years, and so it's well worth the time to appeal them. I'll let you know, for those of you that are clients, we will walk you through the entire process. Happy to do that. Paperwork takes 5 minutes, maybe 7 minutes to fill out, not very long, and it's just faxed in or mailed in or dropped off at a local Social Security office, and you'll win the appeal. Now, I would tell you, when you first go on Medicare, here's what's going to happen. You're going to get a letter and maybe even an invoice that will not include the IRMA. The first bill normally will not. It'll just say you're going to pay the base premium for your Part B premium, and then about 2 weeks later, maybe 3 weeks later, then you're going to get a letter saying, hey, by the way, we heard from the IRS that you're high income. Here's what we're saying, or here's what they're saying your income is, and you're going to have an additional amount that you owe called the IRMA. And then they're saying if these numbers are not correct or you've had a life-changing event, they like to hear from you within 10 days. And so now you can appeal anytime you want to, but my experience has been they will go retroactive for that year. They won't go back to previous years. So we always encourage our clients, once you have the IRMA letter and you are going to have a life-changing event, you have an appealable reason, then do that as quickly as possible so those IRMAs will fall off.
Yeah.
Okay.
And it's important to wait till you have that documentation before
Good
you send
point.
it back in, is right.
Yeah. Well, in fact, don't appeal an IRMA until you have the IRMA letter or the IRMA invoice, because they do not want to see your appeal paperwork. They want to make sure that it's in the system and now it's time to appeal. So don't do it too early. Some people proactive, and they know they're going to get it and they want to apply. You can't do that.
Right.
All right. And also, you can't put a future date down either. So if you say, well, I'm going to retire in 6 months, well, that's not going to work because you may change their mind. Sure. So that event has had to occur in order to make that appeal.
Sure.
All right.
Absolutely. We'll kind of take one of the first questions here. So Thomas writes in, how likely can I get an IRMA abated if my modified adjusted gross income is very high the year I retire because of hours being cut 2/3, resulting in him drawing down on his 401k by $100,000?
Okay. Well, you give a stab at that, because quite frankly, I'm not exactly sure what he's asking.
Sure.
Is it very high? He says I lose my hours, but then I'm drawing my 401k
Sure.
down by 100. Can you?
Right.
How do you interpret
so
that
essentially,
question?
kind of what I interpret this as is so he has to retire because the hours being cut by 2/3. So he's having to retire, and essentially to overcompensate for the loss of income, he's taking $100,000 out of his 401k. So this is a life-changing event.
Okay.
Because this is obviously you're retiring, you're no longer working. However, the money that you are taking out of your 401k is still going to be
Counted.
increasing your taxable income.
That's
so essentially
exactly
that's something they're still going to be responsible for. So it would have to know whatever money you're making the remainder of that year, in months, and then obviously we add on the $100,000 to kind of see if we would fall underneath that IRMA. But otherwise,
I understand now. So Thomas, if your income's going down because you're retired, then you have an appealable issue. But the income's still up there, regardless of the source of income, whether that's a distribution or any other, rental income.
Sure.
All that is reported. So even though you have the date for a life-changing event, that income sounds like to me it's still going to be high. So I don't think you're going to appeal. For instance, if I made I don't know, $400,000 in 2022. And I retired in 2023, but I'm still making $400,000. My income is still the same. I'm still going to be subject to an IRMA.
Sure.
So they're not going to drop it off just because you retired.
Right.
Hopefully that's helpful. I understand. I didn't quite get the question.
No,
it's my bad, not your bad, sir. It was my bad.
So the next one here, doesn't IRMA automatically go away based on your federal tax return from 2 years back, or must you formally petition Medicare to make this happen? Which you kind of touched on this just a few minutes ago. Essentially, this is something to where if 2 years prior at that point, obviously, that's where we were making that extra income, that does automatically go away for us. But otherwise, that's something we are going to have to appeal.
Oh, that's right. That's right. They're always going to look back 2 years. You have to let them know that you retired, and so nothing's going to go away. Now, keep in mind, if I go into 2024 and they're looking back at 2022, then that 2022 number is going to determine whether I have my IRMA or not. So if it's low, it will go away. But it's not going to go away if your number's high. The IRMA will not go away until you've hit 2 years later when your income is down. Makes sense? I mean, in my mind, it makes sense.
Yeah.
But IRMAs, if you have an IRMA, it does not go away unless you appeal. The only way the IRMA goes away is if, when they look back 2 years, if your income is below those thresholds, then it goes away.
Sure.
Okay.
Yeah. All right, so the next one here about the supplemental policy. So suppose my first doctor visit cost $300. How will I be billed the $226? And how does the doctor get the remaining $74 balance?
Okay. Go ahead. Do you want to give it a crack?
Yeah, sure. So essentially, you're going to be responsible for the first $226 of the year, since that is the deductible. So you'd be responsible for that. And then after that, essentially, that's where the G plan comes in, or the N plan, or whatever supplement policy you have at that point. They cover the remainder of that cost for you. So that's something where essentially they're going to bill whoever the carrier is that you've decided to go with at that point. United Healthcare, Mutual of Omaha, Aetna, whoever it may be, and that's where that $74 remainder comes from.
Yeah.
So.
Exactly right. That's what we tell people when they get the G plan. The first $226 is going to end up as a bill in your mailbox, and I would doubt it's going to be one doctor visit. Just so you know, it's probably more like a couple doctor visits with some lab work, or $226 of an MRI. Doc visits are just not that high, so it's going to be a combination of the first $226 or whatever's billed through the Medicare B system. So if you had an MRI, you've covered it with $226, but doctor visits could be a couple for sure.
Yeah, sure.
Yeah, and the carrier and Medicare both will be tracking that amount for you.
Right.
And so if you have that G plan, be sure you just don't spend any more than $226.
Yeah, absolutely. So the next one here from Eileen. Why do you initially get billed for a quarter versus monthly for Part B? I almost fainted when I got the first bill. I pay monthly now. So yeah, which we hear that actually from a lot of people, and which we try to be extremely preemptive about saying, hey, that first bill is going to be anywhere between 1 to 5 months, right?
2 to 5.
2 to 5
Yep.
months.
2 to 5 months for sure. Yeah. So, and that's just the way the system works. If someone's on Social Security, it's automatic monthly. But if not, your bill, your very first bill, I've seen as low as 2 months. I've seen as high as 5 months. And then after they've paid the first bill, then it's quarterly thereafter. So,
Perfect.
Yeah, that's a lot. Most people are a little shocked by that.
Yes. The next one here. During open enrollment, if I'm enrolled in a G plan and I want to change insurance companies, can I and do I have to go through underwriting? Essentially
Okay.
make that change.
Okay, yeah. Well, first off, when you talk about open enrollment, Doug, I am assuming that you're talking about this upcoming open enrollment season, October 15th through December 7th. Is that the way you read
Yeah,
this?
exactly.
Okay, very good. All right. So when you think about open enrollment, October 15th, December 7th, it has nothing at all to do with supplemental plans. It has everything to do with Medicare Advantage plans and prescription drug plans. The reason for that is because prescription drug plans and Advantage plans are only written for 1 calendar year. And Medicare gives the insurance companies that write those Advantage plans and drug plans the right to change anything they want to from year to year. And so that's why the consumers that are on those plans, drug plans and Advantage plans, have the right to switch if it's in their best interest to do so. So that's what open enrollment is all about. Your G plan, Doug, no matter where you live, it was written guaranteed renewable for life. It is truly a lifetime policy. That's one of the reasons I like them, because you can never lose your G plan, nor do you ever have to change your G plan for your whole life, regardless of age, regardless of claims, regardless of where you live. It is truly your plan for life. Okay, so you don't have to worry about changing it. So it has nothing to do with this open enrollment season. Now, if down the road you would like to change insurance companies, that's what he's asking. I want to change insurance companies. This has everything to do with where you live, because here's the way it works. There are some states that will allow you to change carriers for the purpose of saving premium dollars at one time a year. These states are called birthday rule states. And so this is someone that's already been on the supplemental plan, and they're coming up for their anniversary date, or when their policy is been enforced for a year and then 2 years. So this happens about every year. If your company takes a price increase, there are some states that allow you around your birthday, typically 30 days before birthday, maybe 30 days after. Sometimes it's your birthday month for the next 2 months, but there's birthday rule states that allow you to switch carriers from one plan to another, like to like they call it, or like to less. So if I'm on a G plan, I can move to another G. If I'm on a G, I can move down to an N plan, and I don't have to go through underwriting at a certain time of the year. And those birthday rule states, they're real simple. Those birthday rule states are California, Oregon, Washington is one, but Washington allows this to happen all year long. And then the state of Idaho, the state of Nevada, Illinois, Louisiana, now Maryland, and next year will be Kentucky. Okay, and so we have those birthday rule states, and then there's one state called anniversary rule state, which is my home state, which is Missouri. Same concept. They just call it anniversary because it's tied not to the birthday, but to the anniversary effective date of your policy. And so during this window of time, and again, wherever you live, you can find out, you can call us and we'll show you how to do this. But if it's a birthday rule or the anniversary in Missouri, you have this window of time. It's typically about 60 days where you can change carriers. Now, the state of Illinois is kind of unique in that you can only do this between the age of 65 and 75, right? Yeah. The state of, I think it's Connecticut, they allow you to do it, but it's only Mutual of Omaha or United Healthcare. So there's a few unique states, but my whole point is there are a few states where you don't have to go through underwriting if you exercise this right during birthday rule or anniversary Missouri. Right. The majority of states don't have that, though. Exactly. That's the whole point. So we can get any Medicare supplemental company, plan letter company that we want that's sold in our state when we first go on Medicare. We can apply 6 months before our B date, but that period of time where there's no underwriting goes on for 6 more months after our B date. But that window of time is the only time in most states we can ever get a Medicare supplemental policy or add one or switch one without underwriting. The majority of states make us go through underwriting, which is why we tell people, number one, I care about initial premium, but I also care about stability of rates. So a lot of times people get hung up on what's the first year rate. Well, I care about that, but I'd rather look back at the last 10 years of how this company's performed. Right. So when people work with us, I want you to know we're going to look at stability of rates. How often does a company take rate increases? How drastic have those been? Because we bring that into the decision as well. Okay?
Yeah. No, absolutely.
That's the way it works.
Yeah. So the next one here, how does a 401k IRA and cash savings figure into IRMA? And this is something we had kind of touched on just a little bit ago, but obviously
it all counts.
Yeah, exactly right.
It all counts.
Essentially, everything that is considered taxable income is going to be that way. So obviously, if we're looking at Roth IRAs, that's after-tax income, so that's not attributed to our taxable income since we've already paid taxes on it whenever we go to withdraw that money. But anything else that has not been taxed, obviously, that's where it is affecting your taxable income there. So. Perfect. So let's see here. So Edwin's.
With SSA.
I think it's Social Security income. I think is what we're talking about here.
Okay, so can you pull the question up again?
Yeah. So
Okay.
it is. I'll just read it out. Taxes in relationship with SSA. Is it pre-tax or after?
Oh, okay. I think what he's saying is
It's more-
how much of your Social Security income is going to be taxable. So if they're taking out the Part B premium out of your Social Security check, is that going to be considered in provisional income? Okay. So here's, and by the way, I am a financial advisor, licensed and to do all that kind of stuff, but I'm not an accountant. So in regards to your question, if I understand it correctly, you're wanting to know, will a Part B premium reduce my provisional income number? And my answer to that is no, it does not. So what happens whenever we're determining how much of our Social Security income is taxable? Number one, 100% of it is never taxable. They actually have 3 levels of taxes for our Social Security income. And the formula is actually called provisional income. So we have to know our provisional income to know how much of our Social Security is taxable. So what we have is a provisional income formula is your modified adjusted gross income that we just talked about, line 11 plus line 2A. And then you add back in 50% of your Social Security benefits. So if you're making $2,500 a month in this equation, you're going to add $1,250 back in. So again, modified adjusted gross income plus 50% of your Social Security income equals your provisional income. And then the provisional income is put to a table, and those tables are really pretty simple. They have thresholds. And so provisional income for a single person, if you are below $25,000 a year provisional income, 0% of your Social Security will be taxable. If you are $34,000 to $25,000, 50% of your Social Security is taxable. But if you're a single person and you're above $34,000 provisional income, 85% of your Social Security income is taxable. On the married side of the equation, the bottom threshold is $32,000. So if I'm below $32,000, 0 is my Social Security is taxable. Between 32 and 44, 50% of my Social Security is taxable. If I'm above 44,000 provisional income, 85% of my Social Security is going to be reported on the return and therefore taxable. Yeah. I think that's what he's asking. So he's asking, will my Part B premium affect that? And my answer is, I don't think so, because I think it's your gross Social Security eligibility that is considered for your provisional income number.
Yeah, absolutely.
Okay.
Cool. So here's a little bit more of a personal one here from Tony. So I plan to retire at 67 from a company with more than 1,000 employees. July 1st, 2024. I've not signed up for Medicare. How soon should I apply for Medicare A and B? Thank you in advance.
Okay, plan to retire. Okay, very good. All right, at 67. Okay, so the best time frame, just back up the clock 3 months. Yep. So employees on July 1. So it sounds like to me you want your Medicare to start July 1. So here's what I would do. Let's back it up June, back it up May, and then April. And so then April 1 would be the right date to get the process of enrollment going.
Right.
So what you're going to do, because you're coming in at 67 and not 65, you're going to be in, Tony, what's called your special election period. And there is a form called an L564 that if you work with us, we'll supply this. You can go online and get an L564. You can fill out the Section A, but Section B has to be filled out by your employer. Now, if you've been with the same employer from 65 to 67, we only have to have one L564. But if you happen to change jobs during that period of time, we have to have both employers verifying. Yep. So the L564 is what your HR fills out to prove that you've been working actively. And by the way, this could even been your spouse working, but you or your spouse working, covered by an active employment provided insurance plan back to 65. And so that form, you do not want it to be any older than 90 days when you submit it to the local Social Security office. So that's why I'm saying you want to start this process around April 1. HR fills out the L564. Then you personally fill out, or we'll do it for you, a form called the CMS 40B. It's a very simple form, and you're telling Medicare when you want to start your Medicare Part B, which of course will be July 1. So you will put in your name, your address, your Social Security number, you'll sign it. And the important thing, Tony, is there's a comment section at the bottom of the 40B. And you're going to say, please begin my Medicare Part B July 1, 2024. So after April 1, HR fills out the L564, you fill out the CMS 40B, and you're going to submit those to your local Social Security office. You can drop them off, you can mail them in, you can fax them in. I will tell you, if you mail them in or fax them in, we like both.
Yeah.
If they fax in, I definitely would mail a hard copy in to make sure that they get that, put a note on there, let them know that. And that paperwork will bring you into Medicare Part B with no penalties and no problems. Now, just one warning here, and for you or anyone. If, Tony, let's say you have an HSA, a health savings account, not flexible spending, not HRA, health reimbursement arrangement, but a true HSA, and you apply for your Medicare, as I'm suggesting, which is the right way to go. What I would do is I would apply for my Medicare A online, so that's all in the system. So when this L564 and 40B form come in, they will process that. You've applied for A, the paperwork brings us into B with no penalties, no problems. But what they're going to do, apply for Medicare in April, they're going to backdate 6 months. So we're going back March, February, January, December, November, October. So you're going to have an A date of October 1, 2023. They always backdate 6 months. Now, they'll never backdate before my 65th birth month, but they always go back 6 months or to my 65th birth month, whatever is going to be first. And so you're going to have an A date of October 1, which means if you have an HSA, you do not want to contribute any new money to your HSA after September contribution. Now you can max out right now. That's about $5,000 a month. $5,000 a month, $5,000 a year is $4,850 divided by 12. You can put the max in for those 9 months, but no new money can go in your HSA once you have Medicare A. And a lot of people don't realize that if they keep working and they contribute to an HSA, that if they go beyond that A date, those contributions were ineligible. And if you keep maxing out, that means you over-contributed and you're going to have a 6% penalty plus taxes due.
Yeah.
All right, that's the way it works.
Yeah. HSA is a lot of moving pieces with this, especially.
Right.
So
yeah, they're great to have. I love
Yeah.
HSAs. Just make sure if you keep working after 65, they're going to backdate that A date.
And that 6 months is that from the application of the A date?
Application.
Application
Yeah,
of
not
the A date.
effective date of the B.
Right.
It's application, and they'll backdate it.
Perfect. All right, so next one here. What date did they determine an IRMA? What date do they look back 2 years from?
Each year. So if I'm on Medicare, David, in 2023, they're looking automatically back at 2021. So when we roll to 2024, everyone that's on Medicare, they're going to look at their 2022 tax return at the MAGI. And they keep doing that until you say, hey, I've had a life-changing event, marriage, death, divorce, work stoppage, work reduction, and we're saying to them through the appeal, stop looking back. I want you to look back 1 year, or I project the year that we're in, and they will do so.
For sure.
Okay.
For sure. All right. So, isn't there generally a more ill pool of people in the G plan than the N plan, causing greater premium increases? I've read lots about G plans going up faster now. Is this true?
Okay. Well, you may have read that G plans are going up faster now, but it's not because of that. Okay. And let me tell you why. And I know, and by the way, some of my friends who are in this business that are wonderful people also kind of go with this narrative. Okay, and what they're saying is that you ought to get an N plan because everyone's getting a G plan because it's the guaranteed issue product. And I'm just telling you, though those people who promote that are great folks, truthful people, I think they're skewed on this fact, and I'm going to tell you why. Because 97% of all people, thereabouts. I got this from an insurance company, so I believe that the stat's right. But let's say 95 to 97% of all people that are going on Medicare are going on Medicare for the first time, either at 65 or they're coming in at a later date using an SEP. Okay, that's the majority way people are coming into these MedSup plans, and when they come in during this period of time, which we call the Medigap open enrollment period, they can have a G plan or an N plan. So to assume that everyone is getting a G plan at that time is not correct. There's unhealthy people originally going on G plans, unhealthy people originally going on N plans. That's just the fact. That's what's going on, and this happens every day. So when it comes to guaranteed issue business, and this is what your question is all about, and my friends who push this narrative, what they're saying is that there's a lot of guaranteed issue business written, meaning people had A and B and they were on a group plan at work and now they're going to go onto a Medicare supplemental plan. Well, I ask about that. And there's only 3% of all the people when they come onto Medicare are going to be in a guaranteed issue status. 3%. Okay, and so that's the group, yes, that they have to have a G plan if they're born after January 1st, 1955. F plan if they're born before January 1st, 55. So it's only 3%. So when we want to say that G's are going to go up because all the unhealthy people are going on, that's not true. Because all the unhealthy people have the chance to go on in as well. And some are going to choose that for the lower premium. So I just don't buy the narrative. Now, by the way, if you choose an in plan, I am fine with that. We write in plans all day long. We do. And I'm happy with an in plan. I just want to make sure that people understand that if you happen to go to a doctor that charges excess on the in plan, you're going to be responsible for it. And there are people that have that happen regularly. You go through cancer, you go to a specialty center, they're going to charge excess as well. So what are you saving? $30, $35 a month? And what could excess be? $10,000 plus 15%, that could be $1,500.
Yeah.
So that savings is wiped out with one excess charge for years. Plus you have $20 copays at doctor visits, $50 to the ER. So for me, in my own personal budget, I just still like the G because I don't like surprises. I like a lower premium, but I don't want to take on the risk of excess charges. Now, I know the fact 1 out of 10 charge them right now, but I know that could change down the road. 5 years from now, maybe half of all doctors do it. They all can do it if they want to do it. They don't do it because it frustrates their patients. And so that's still the reason I personally would prefer a G plan. But if you want to go an in plan, that is fine. It is certainly fine. But don't assume that just because all the unhealthy people are going on G's, all the healthy people are going on in. That's not true. Lots of people that aren't in taking in plans, they're unhealthy because they're in their Medigap open enrollment period.
Right.
Okay, enough said.
Exactly. Perfect. So Catherine, so do we have to appeal essentially to IRMA here each year to get below that threshold, or until we are below that threshold?
And the answer is yes, but only for 2 years.
Yeah.
So if I retire 2023, they're looking at 2021, I can ask them not to. And then in 2024, they're looking at 2022. Again, I retired, so I can appeal 2 different years. So the answer is yes. You have to get the IRMAs dropped.
Something I'll kind of add on here for this is with, so each year, so obviously whenever you have that life-changing event, obviously we're going to appeal. We've got the 10 days to essentially reach back out whenever we get that notice of surcharge, essentially. Now, come around, is that, so at the beginning of the year, my understanding has always been, coming January, obviously we're moving to that new tax year. Essentially, we get 60 days to appeal that for that IRMA then, or essentially, or we got another 10 days once we get that notice surcharge the first of the year.
Yeah, I think they can appeal at any time. It's just cleaner and easier to appeal. The sooner you appeal, the better. Right. I have been told. And I do have a life-changing event that happened the year before. I still qualified, and my understanding is they will retroactive it for that year, but they won't go back. So for that year, they won't go back. The IRMA numbers are not out yet. I think they'll be out. We should have them by November. The Social Security number will be out in October. Numbers come out in November, and then they will be sending out the IRMA letters sometime. Everyone gets them usually in December, and so we just tell people appeal them as soon as you possibly can. Hope that helps.
Yeah, absolutely. So there's 2 people here, and I'll just kind of add these real quick, and so I'll just kind of throw these up here, and these are kind of quick hits because we've kind of touched on some of this a little bit before as we've gone through. So how is IRMA affected when it comes to inherited income? Once again, anything that is considered a taxable income to you, essentially that is essentially what you're going to be adding on, or it's going to be increasing your income in that year. And then Scott, essentially Anderson, writes in here, would a Roth IRA conversion, that taxable event, in the year you turn 63, deducted from your modified adjusted gross income when calculating my Medicare Part B premium at age 65. So essentially, once again, go ahead.
Okay, no, go ahead.
I was going to say we're looking back 2 years. So essentially, if it was done, it's a taxable event, so it is still increasing that ordinary income. So you're still looking at probably going to, depending upon obviously your tax filing status and what the income was at that time and how much you're rolling over at that point. It just kind of depends, but more than likely, if we're in excess of the $194,000 for couples, essentially, then yeah, you're going to be looking at that IRMA.
That's right. Yeah, it's not going to be deducted. That would not be a reason for them to change your numbers when you do those Roth conversions. The good thing for you, Scott, is really the timing of this conversion, because if you happen to retire at age 65 and they're naturally looking back at 63 where you're a high income, if you have a life-changing event, you say I've retired and your income has changed, give them your projected income for 65. And you really got the blessings because they don't ask you where is that money sourced from. So when people do these conversions at the right time, they can really help themselves.
Oh, for sure.
Yeah, and so it is better to do them earlier, up to the limits, of course, because then it's not held against you because you have this life-changing event that's offsetting that Roth conversion. Because again, they don't ask you why was that income high.
Right.
As long as it's you've semi-retired or retired at the same time, then you're gonna be good to go. In fact, I've had people who had this situation and they just cut their hours back five hours a week for this reason, have a life-changing event, so the government would not look back 2 years, but would look at the current year.
Right.
And it's legal. Hey, I'm never promoting any dishonesty, but they just partially cut back because the form says
hours.
work reduction. That's it. They don't say how much you reduced it. Your income just has to go down because of that.
Yeah, wasn't reduced at all, for sure. All right, so J.S. Irwin here. I understand the G plans go up every year. We all get old if we are lucky. What age would it be financially better to switch to an Advantage plan, PPO specifically?
Right. Okay. Well, first off, G plans in most states are going to go up on an annual basis because most states are attained age. So you're going to see at your anniversary date usually a slight increase. If you go with the right carrier, you probably should not see a drastic increase. Mr. Irwin or Miss Irwin, whoever it is, I would agree with that. So if we all get old, then if we're lucky, about what age would it be financially better to switch to an Advantage plan? Well, let me just share this with you. I had somebody recently, a client of mine, whose dad is 102.
Wow.
And his premium has gone up over those almost 40 years.
I can imagine.
And so my rule of thumb would be if your premium on your supplemental plan is higher than your max out of pocket on that PPO plan, then I think it warrants you looking at the Advantage. Okay? Let me say it again. So if my premium is going to be higher for my sup plan, and this guy was on an F plan,
Sure.
then I think it makes sense. But let's all be reminded, if you make that switch, you're still going to have some of the disadvantages on the Advantage plan. Yeah, financially, premiums may make sense, but you still have networks, you still have pre-authorizations, and you're not going to get off that thing now for the rest of your life. So I think you got to weigh all that in. Yeah. But I think that would be the time to do it.
Yeah, and I think that's what a lot of people have to really factor in exactly what you're getting at there is what level of care are we wanting at that point? Because if we look at this financially, yeah, sure, we can just talk about numbers, but essentially, what's the quality of life at this point? How much are you going to have to essentially potentially struggle against the insurance companies to get the kind of care that you want to? Right. Huge importance for all that stuff. You want to continue to see the doctors you've been used to, because Lord knows you get in those PPO plans. If you go out of network for one of those policies, you're paying more for it anyway.
That's right.
Anyway, yeah, all that.
So there's a lot more that goes into it. And I appreciate what you said because it's true. An interesting situation happened. This goes, 3 or 4 months ago. Had a husband and wife, elderly. They were in their mid 80s. She was in a skilled nursing facility on an Advantage plan as usual. They cut her off quickly. She should have stayed in there longer, but they made her go home. They said, we're not going to pay anymore. And so she goes home. Husband tries to take care of her. I don't know if you've even heard this story before.
I have not.
Yeah. Anyway, so husband takes care of her, and she needs a lot of care. She should have stayed in the skilled nursing facility. Advantage plan cut her off, as they often do. And he's trying to take care of her, goes out to mow the lawn, has a heart attack, dies.
Oh,
okay, now, that's not the Advantage plan's fault, but I know they put undue stress on that man because now he's going to take care of her, 85, and he should not have been. She should have still been at skilled nursing facility. If that person had been on a supplemental plan, that would not have happened because the insurance company has no say-so. And that is one of my beefs with Advantage plans. Yep. And listen, so you all know, we make more money on Advantage plans. The reasons agents push Advantage plans because they pay a higher commission. We get twice the commission and we get lifetime residual. That's why they promote them. And I'm all right with them. But in our practice, 18% of our people get Advantage, 82% get subs, 82%. And the reason is because we just simply tell you about both. We want you to look at the plus and the minus of everything and make a decision. Why? Because I'm not so concerned about my commission. I'm concerned about your coverage because you have to live the consequences of that decision. So when you have people, all they want to do is push Advantage plans, I don't think they care about you like they should. Right. If you buy it, that's fine. But you need options on both.
Yeah, as long as you're well educated, you're making a most informed decision. I mean, really, at the end of the day, this is your call. But I mean, obviously, we're not pushing you one way or another. But essentially, we want you to just be extremely informed when it comes to all this stuff because we don't want to look at just what today is, what those financial numbers are. It is, hey, let's take a realistic look. If you're sitting in that chair at 85, what do you really want that health coverage to look like for you?
That's right.
So, anyway,
That's right.
All right, so. Just says ask here. So just received my Social Security award letter. The letter does not note that I already paid my Part B premium for the next quarter. Will SSA credit back the Part B premium for these 3 months? Do I need to appeal?
Okay. Well, the way the system works is it is supposed to refund that money to you. But I would tell you, I'd probably give them maybe 2-3 months. If you don't see that being processed, then I would reach out to them and make sure you do get your money back. I will tell you this: I've had this happen plenty of times, and they always make it right. They're not going to hold on to your money, but they may hold on to your money longer than you want them to. But I've always seen this really work out. Okay, but again, give them a little bit of time, and then call your local office. Let them know, hey, I haven't seen any money back yet, and they'll tell you where in that process you stand. Okay, so you'll get it back, but you may have to be proactive if you don't want it to last forever.
Yeah, for sure. All right, so the next one here is from Doug. How do I set up my premium payments on auto pay for my bank account? Do you guys help set that up whenever I enroll with you guys in Medicare? Yeah, absolutely. So essentially, we've got the Medicare Easy Pay form is kind of what you're going to do. Yes, that is something we absolutely help with. You're just going to send that into your local Social Security office, and it's going to get those moved over for those of you who aren't taking Social Security just yet. Obviously, that's where it comes out, the bank account. Whenever you do go ahead and start taking that Social Security income at that point, that's whenever essentially it's just going to be automatically switched over. They prefer just to take it from there. They kind of just take it off the top of that Social Security. But yeah, that is absolutely something we help with, something we take care of for you. And if something you don't want to send a form in, you actually have another option of how you can do that with Medicare.gov. Essentially, My Medicare. Yeah, there we go. And you just sign in, create an account there, put in your information. You'll be able to set up those automatic payments there as well. So, yeah.
And Doug, let me share this with you as well. You have to set the auto pay up though through their system, okay? Meaning they'll tell you how to do that. That's what Gary was talking about. It's called it's called Easy Pay, or it's mymedicare.gov. Okay, you just can't take your invoice they send to you and try to set up that way. That will not work. I've seen people try that. That's unsuccessful. So follow Easy Pay or follow the mymedicare.gov system. And by the way, you can pay with a credit card too, which is awesome if you keep points.
Yeah, absolutely. Yep. That's it's almost like the DMV. You've got to have their forms exactly like the way they want it. And so Medicare is obviously no different. We talk about L564s, 40Bs. Medicare Easy Pay, just another form, but that's something that, once again, whenever you call in and talk to us, that's something we help you guys with for sure.
Happy to do it.
Absolutely. All right. So Barbara, if I'm receiving Social Security disability and I'm going to turn 65, but I'm already receiving Social Security disability and Medicare, do I have to apply for Medicare again?
Take it.
Yeah, you do not. Essentially, whenever you are already enrolled, it's something where whenever you do turn 65, you actually do have another open enrollment period, so which you can switch into a new policy if you'd like to, supplement or Advantage. But no, it is not something you have to apply for all over again.
Good. I just want to add to that, Barbara. We call that the IEP2. Yeah. Your initial enrollment period is when you first go on Medicare. You had that, of course, because of disability. But then when you turn 65, you're able to basically reset the clock. And the beautiful thing about that, Barbara, is this. I don't know where you live, but in some states, you can't even get a MedSup plan below 65. That's the federal guidelines. Now, some states you can, few of them, but now that you're turning 65, even if you're in a state where you couldn't get a supplemental plan initially, now you can. Or if you're in a state where you did get a supplemental plan, you probably paid more money for it because sometimes the rates are higher for a disability case. But once you turn 65, it's as though you're brand new and you just pay those normal 65-year-old rates. So take the time to do that. No health questions asked. You can get the supplemental plan of your choice.
Perfect. All right. So Craig said, you mentioned the L5, well, I'm assuming 564 form. You should not be more than 90 days old, essentially 90 days out. I'm 68, retired, 12/31 of 21. and that's on the date of my prior employer's form.
Right.
Is that a problem, essentially?
And it's not because of what he says then. Currently
Yep.
on spouse's employer plan. So all that means, Craig, is you're actually going to have two forms. You're going to get the one that you have now, and it's fine with the date on there. But your spouse that has you covered now, that HR department's going to fill out one as well. So when you submit both of those forms, the government's going to clearly see why it is that one has the old date. Mm-hmm. Yeah, so that is fine. Then that's kind of an exception to the rule. I didn't think to clarify that, but you're right. You're fine with that form. But if that was verifying present employment, we got a real problem.
Right.
Okay, yeah, so that's why you can get by with that, Craig. So just have your wife's employer, your spouse employer, fill out the L564, and that form I don't want any older than 90 days. So take your original one and the one you get from your spouse, submit those within 90 days of your effective date for your Part B, and you'll be good to go, sir.
Absolutely.
Yeah.
Perfect. All right. Next one here. Let's say mom and dad has Medicare A and B effective 2019 and on Employer Advantage Plan insurance. Can they move to a MedSup 10-1 with guarantee issue?
Okay. And the answer to that is yes, they can. Now, here's the rules. If they are born before, and by the way, there are a couple states with this exception. I don't know where you're from, but in most states, the great majority of states, if they're born before January 1st, 1955, which is possible since they have a 2019, because 2019 date would means they were born. What were born in then in 54. Yeah, 54. Yeah, so they have a B date of 2019. That tells me they were born in 1954 because they were eligible at 2019. That's right. So more than likely your folks are guaranteed issue on an F plan. Anyone starting Medicare after January 1, 2020 would then be eligible for a guaranteed issue G plan. And that's back to what I was telling you all earlier. See, this is that small group of people, about 3%, that would have to take the G in that instance, but your folks are going to probably have to take the F plan. So the answer is yes. Now, I think they can make that move at any time, Garrett. Would that be correct? I don't think they have to wait to like a AEP or OEP season.
No,
So
they wouldn't.
yeah,
They wouldn't have to.
and you can do that 10-1 guaranteed issue. Now here's what has to happen. You got to keep this in mind. Insurance companies don't like this kind of situation. So what will have to happen? They will take your policy. They will approve it pending proof that your folks were covered and have lost that coverage, which is a termination letter. And sometimes those can be, you'll get it, but sometimes it takes a little time. So just trust me. If you were our client, what we would do is we'd tell you that policy will go into effect for sure, guaranteed issue on 10-1, but you may not have your card until you cancel that group plan at work, employer plan, and then that will initiate the process for them to send a termination letter, and then that termination letter will have to be given to the insurance company, and then they will issue those cards.
Right.
You will be covered 10-1, but you may not have a card then. Go ahead.
Yeah, no, I mean, that's something we have to tell people, a lot of people, is it's not going to feel like you have insurance for probably about 2 to 3 weeks, because we got to wait for that policy to terminate. We got to get that termination letter, then we got to make sure that gets all the way back over to the insurance company before they obviously issue the policy. It is going to be backdated. You're going to have coverage, and essentially it's called guaranteed issue for a reason. It's guaranteed, but it's not going to feel like you have coverage. So it is something to do, but I mean, it's something to keep in mind, that you probably have to, just make sure that your parents were aware, like, hey, it's going to feel like you're uncovered, but you're not, because this is a guaranteed issue situation. So.
All right. And also, Ms. Jones, let me add this. Maybe your parents have some health issues, and if they do, then I would go with the guaranteed issue. But if they don't have health issues, then you could put them through underwriting. You have every right to do that. And if they get approved, then they could get a G plan or an N plan.
Yeah.
Either way.
And that's going to be one of our first questions anyway. It's a lot simpler of a process to go through for most folks. Well, I say for those folks who are going to qualify, it's a lot faster. There's a much faster turnaround on that stuff. But obviously, we've got the guarantee issue if we need to.
That's right.
It's a little bit longer of a process, but
that's your ace in the hole, though.
Exactly.
Yeah,
exactly right. So, all right. So Elizabeth writes in here for us. So if we go with an Advantage plan, we have to stay with them and cannot go back to a G or an N plan.
Okay. All right. So here's the way that works. If you have an Advantage plan and you keep that for any length of time, and I'm talking about year, 2, 3, 4, 5 years, you stay on that plan. To get on a supplemental plan from an Advantage to a supplemental plan, then you're going to have to medically qualify to do that, except in 4 states: New York, Connecticut, Maine, and Massachusetts. Those 4 states do not require that you go through underwriting at any time. Okay, Maine's a little unique, the month of June. The rest of them, but there's 4 states. All 46 of the other states and the District of Columbia, if you're on that Advantage plan for any length of time, you're going to have to medically qualify, take it off of that. So it doesn't mean you have to stay on the Advantage plan. It just simply means that if you can't qualify, yes, you have to stay on that Advantage plan. Okay? Right. And so that's one of the issues. That's one of the disadvantages of Advantage plan. If people's health changes, then it could be their permanent plan. Okay, did we answer all of our questions? Do we have to stay with them and can't go back to a G or an N?
Let me see if I can go back up here a little bit. I think, I think so, because that was all of it, what she had written there. So
Yeah, and keep this in mind too, Elizabeth. If you, let's say you're on that G or N plan and you move to an Advantage plan, that first year you have the right to go back, but you can only go back to your original carrier. That's it. You can't just, without underwriting, can't just pick a new carrier, a new plan. That original insurance company has to take you back, but just that first year only.
Perfect. All right, so the next one here, Louise. I think I'm saying that right. I believe so. So why do you not talk about the high deductible Plan G? What is your opinion on that plan?
Yeah. Well, if a person wants a high G, then that's their business.
Sure.
I wouldn't discourage you from it. Our problem as a company is, yes, they're a lower premium, but the problem is, Louise, if you go on that high deductible G plan, is it what this year, $2,800?
$2,700.
Okay. You have a deductible. In order to get off that G plan, high G, and go to just a normal G plan, you have to medically qualify to do that. So you may save some money right now, but if your health changes, now all of a sudden you're spending that deductible amount every single year. And so we just don't like to put people in that position. But again, if you think that's in your best interest, that's certainly fine. But that's why I don't talk about them, because you have to qualify to get off of them.
Right, and that's something too, like whenever we have the conversation with customers is, we like to look at this, what is potentially the worst case scenario? I mean, we look at best case scenario as well. I mean, sometimes those premiums are $50 to $75, but you're also responsible for that next $2,700. And whenever we do the math for like the monthly cost of that versus a G plan generally in your area, it almost never makes sense when it comes to worst case scenario. I've never seen it make sense. Worst case scenario, where a high deductible G plan is also something where it's going to be outweighing or saving you money in the long term whenever it comes to the G policy, given worst case scenario. And also, it's something that whenever I was an agent, I only talked about maybe once a month, once a quarter. And so if we're talking about rate stability, which is I know something we talk a lot about, how big is that pool of insurance of folks we're getting inside of? If I'm only talking about it once a quarter, and people are asking us loads of questions, that pool of insurance isn't very big. So God forbid that somebody gets unhealthy there and those rates go up a little bit. They're going to climb faster. Not to mention, I think last year the rate or the deductible on that was $2,450, and it went up $250 to $2,700. So that number is going to continue to climb as well. So anyway, we've never seen the pros. Well, really the cons outweigh the pros there for that one. So. All right. In recent years, what range percentage increases have been applied to IRMA levels?
I think it's very similar to the cost of living adjustments. Yeah, because I looked at right now. So right now, there's no accurate numbers out yet. But I read on this the other day. They're speculating the IRMA thresholds to be right now. They're 97,000. They think they'll go to about 105. And so we're anticipating the a cost of living adjustment to be somewhere between 3 to 3.5%. So if you do the math on that, I'm not sure where they're coming up with that. But anyway, so there is definitely an index that determines that. That's not a random number. So to answer the question, so if it goes from 97 to 105, what would that be? That's about 8%, 7 or 8% or so.
Yeah, because I think last
Sorry
year,
about that. We track it all the time, but I've never done the exact math on it.
I kind of just think about the numbers because last year was 87?
Yeah, I was going to say 87.
I think it's 87.
And we moved to 97.
97, so it went up 10 grand. So it's not going to go up as much as it went up last year. But anyway.
Sorry about that.
Yeah, is what it is there. So
can't answer it.
Perfect. So Terry went back to work and on their insurance, dropping Medicare to avoid underwriting for a supplement, and then planned to re-enter, or essentially, plan to re-retire January 1, want to sign up with an SEP on the right track.
Yeah.
So
That's right.
is there a little bit of catch-22 here, though? 'Cause
Well,
when
no,
you
I
roll
think
it
she's on the right track for sure. It's fine to do that. Just know that here's what you're going to do. I don't know when you first went on Medicare and then since dropped it, but if you came on at 65 and had the supplemental plan, as long as your group plan went into effect when the supplemental plan was dropped and we have no gaps in coverage, you're on the right track. In other words, you're eligible for an SEP. If you, let's say you're working at 65 and then you retired at 66, then I have to have an L564 from that employer. Point is, I got to go back to 65 to prove to the local Social Security office that you have had either active employment insurance or you were on Medicare. And as long as you have done that and can prove that, you're on the right track.
Right. Yep.
And by the way, I think it's smart to do that.
Yeah, absolutely.
It's a waste of money, in my opinion, if you have a group plan of 20 or more to be on Medicare B, unless your group plan's lousy.
Yeah. All right, so Ray, I've reached 40 credits back in February. I went to the Social Security office now 4 times in 4.5 months, and I still have to pay parts A and B, despite requesting from the remove A. What do I do?
Okay, very good. So I am assuming that they ask you for some type of proof. I think you can use W-2s, you can use pay stubs. In other words, there's documentation to prove that you had that income counting towards those quarters. And so as long as you have supplied them with that information, then those records hopefully will get up to date really soon. And I think they will reimburse you. So let's say that you should have had your 40 quarters and should be paying no extra premium for the A or the B. Let's say May 1. And they've been billing you since May 1. I think that you will get a refund for those premiums that you should not have been billed for. That's the way the system should work. So the question is, have you given the proper proof? Is all that documented within the system? I think they will correct that. So that's the first thing I would do.
Yeah.
Make sure on that. But the reason this happens is because a lot of this is about a year behind. So if you have 40 quarters, it could be that your 22 income was reported late, and that's why, or whatever. These reports get behind. But I think they will make that right for you. But stay on it for sure.
And to his point, talking about time, I mean, where this video started is, dealing with IRMAs is a 2-year look back, because we know, like, if we are still trying to file 2022 taxes, some people have extensions up until October the 15th. And so that's why there's a 2-year look back period for that, to essentially compensate for everybody making sure they're getting their taxes filed and essentially getting all that set up. So, yeah, the unfortunate piece is it does take time. We got to have a little bit of patience with that stuff, but, most of the time it does get straightened out there.
Yeah. I see your question, though, too, also, Ray. Back in February. Okay, good. So I think your A premium, you're probably paying $278 a month for that. So I think you'll get your credit back to February. Your Part B, I mean, it should be the same anyways. I don't think you're paying extra on that. It's not going to be free. It's still going to be $164.90, unless there was maybe some kind of penalty assessed on it. That could be the case. But I think that if you were getting a penalty on B, I think they'll retroactive that back to February and get your money.
Perfect. All right, so the next one I've got here is from Anita. I am retired and on a health plan PPO for my company, and I turned 65 in June, currently receiving SSI. I want regular Medicare with a supplement plan. Will I have a problem changing?
No, not at all, because Anita, you're going into your initial enrollment period. So you turn 65 in June. Obviously, that's next year. So back at the clock, May, April, March. So after March the 1st, you're okay. Well, actually, for you, your Medicare card is going to show up in the mail in February. You'll get it. And then you can begin looking at your other insurance options at that time. You're in your initial enrollment period. You can have any supplemental plan you want sold in your state, whatever's the right drug plan. If you just choose to go with an Advantage plan, you're going to be subject to those. So it will not be a problem whatsoever. You'll have a very smooth transition. And the card will show up in your mailbox in February, 100 days prior to when your coverage begins. Okay? And then you can get whatever you want.
Pretty seamless, straightforward.
That's exactly right.
Not a whole
Now,
lot of extra forms.
Yeah, and I think too, more than likely, what you'll probably have to do is notify your company plan that you are going to drop that plan, because a lot of companies today that offer retirement plans have everyone on an Advantage plan automatically once they hit Medicare eligibility. So you'll probably have to notify to let them know, hey, I don't want that plan any longer. I'm taking a sup plan.
Yeah, absolutely. All right. So Joanne writes in here. So appealing an IRMA. The DST I was in was sold in 2021, 6 years before planned. Listing date of the DST sold was the year was unusually high income. The reduction was before and after. So let me see here, because she had written in, we had missed her question a couple times here, and I wanted to at least go back and touch on it. See here, trying to think here.
Yeah, and the way I see it, Joanne, yeah, unless you started, okay, 2021. So I'm assuming she lost her job in 2021.
I believe so. I know she's been active in here, so I'm trying to wait and see if she writes out another one a little bit here, so that we can kind of go back to it. But Joanne, I'm going to try to go back to your original question here. Maybe that will give us a little bit more of an input. I think I looked at your second app here. So we'll kind of move on to the next question. Joanne, I'll look for yours.
Yeah, and we'll try to answer that. I'm just not quite understanding the situation yet.
Sure.
Go ahead.
So Greg writes in, my spouse does not and will not have 40 quarters, but has been covered under my work policy all along. She turned 65. She has turned 65, and I will turn 65 next year when I retire. Will she have to pay a higher premium?
No, not as long as you all have been married for 1 year, Greg. So that's all that's required to draw 40 quarters off of a married existing spouse. Now, if there's divorce involved, I know there's not, but if there was, then that you have to be married to them 10 years. But because as long as you've been married at least 1 year, and the way that's done, you're not going to be able to apply for that online, Greg. You will need to call the local Social Security office, or she will, and let them know that you're applying for Medicare on your work record, and they'll take that application by phone. Now, when you call in, they'll set the appointment up, and they're going to want some kind of proof, typically a marriage license, and then you'll probably be able to take a picture of that on your phone and send it to them. But that's the only thing that's required. And just so you know, anybody else watching this, one of the reasons I can say this dogmatically that she qualifies, you have to be married a year. And Greg, you are 64 right now. If you were 60, would not be the case, because we cannot draw from an existing spouse, even if we've been married for a year longer, if that spouse is not at least 62 years old. Okay? If they were 61 or 60, I'd have a different story. So you are 62. As long as you've married 1 year, you can prove that. There's no extra premium whatsoever. You're good to go.
Okay, so kind of Joanne did write back in here for us. Excuse me. I'm kind of trying to look on the live feed there. So it says, no, the Delaware statutory trust was sold 6 years earlier than they planned. So it looks like she wrote in here one more time. We'll go all the way down the bottom here. So the DST was supposed to be for 10 years. They decided to, after 4 years, to sell. I had no authority. Here, I'll pull it up there for us. No authority what they decided, and my sister were just invested in the DST. So this is dealing with the IRMA. Back to the original here. I'm trying to...
Okay, yeah.
I'm thinking that these may just be more about the taxable event there. Essentially, anything that's considered a taxable event is still going to increase your ordinary income.
I think her only hope to win the appeal is if you retired, at a work stoppage or work reduction in 2022 or 2023. Then you can appeal, because they're looking at 2021. Sure. That's not going to be adjusted regardless of the source of income. Doesn't matter. Okay, so if we're on 2023 and they're looking at 2021, if you have a life-changing event, semi-retired or retired or whatever those are, in 2022 or 23, you then have an appealable offense. I think the issue with the DST and all that, I don't think it matters. Okay. Now, unless she thinks it's the loss of pension income, which I don't think it is, or employer settlement payment. I've never dealt with one of those ever in my career.
Right.
So that may be something you may check into. And I'm sorry, I'm just not educated in that area because I've never experienced it. But you could maybe Google and look at an employer settlement payment for the IRMA and see if you think that would give you an appealable offense there.
Yeah, and she did kind of finish up here because she's still active with us, which thanks, Joanne, for sticking around with us. So, write the form, asks when the income event went down. The high income was a one-time thing.
Okay.
So,
that doesn't matter. When the income, is she talking about employer settlement payment? Okay.
That's what I'm thinking she's talking about. It's kind of...
Okay, I'm sorry. I jumped to a conclusion there.
Yeah.
We're going to keep going. I care about your question, but I don't know if you're talking about the employer settlement payment. Because if that went down, then that may be it. It says date of life-changing event. So you may have... Do me a favor. Call the local Social Security office. And hopefully you'll get somebody that is knowledgeable that can explain that better, and then you tell them the date. And by the way, if they don't know, then just ask to be transferred to somebody else. Because eventually there'll be somebody in that office that is experienced that will be able to address your question accurately. I'm sorry, I can't. I wish.
And
I
if
could.
it is a one-time event, just last thing I'll touch on this here. If it is a one-time event, generally you can navigate around that anyway with that IRMA form when you were appealing for, hey, the year prior or the year after, essentially, and how we appeal each year with those. So yeah, you can navigate the event essentially. But the one we've got here from Stephen: will medications be going down in 2024, or will we have to research each one, or et cetera? So
Yeah, right. Well, the overall Part D plans are improving. They are improving next year in that for people that take a lot of medications and end up going to the catastrophic phase, meaning they went through the deductible phase, initial coverage phase, they went through the donut hole. Then when they get into catastrophic, there will be a zero copay. This year it's 5%, so they will be going down there. I think most of the premiums are, with the plans, some are going up a little bit, so I don't think premiums are drastically changing. I know a couple of plans are, but as a general rule, Part D, that whole Part D program is improving. The good news is in 2025, it's really improving. We no longer have the donut hole in 2025, and the max out of pocket will be $2,000 for the whole year. That's all you would spend.
Yeah.
Okay, but still check it because your drug plan can be switched October 15th to December 7th. So I would take the time to check it to see if there may be a better plan that you're on. As a general rule, they are getting better.
Yeah. Okay. So the next one here, David, I'm a retired federal employee and turned 65 in April. I have an ordinary amount of income due to inherited IRA. I have Blue Cross Blue Shield, wife's pension system. Should I drop Blue Cross Blue Shield? What is Medicare going to cost?
Okay. All right. Well, number one, I wouldn't necessarily tell you to drop Fed Blue. Okay. I think that's a fine plan to have. Yeah. You're in a unique situation, David, and all federal employees are, in that you don't even have to enroll in Medicare B. You can have Medicare A only. And I know if you've talked to anybody, there's people that have done that. A only. I don't personally like that. I think it's wise to get A and B, because if you get A only now, or in April, when you turn 65, and you want to pick up B at a later date, then you're going to be subject to all the general enrollment period rules. Limited times of enrollment, first quarter of the year, and for every year you go without Part B, you're going to be assessed a 10% penalty. And so I've seen plenty of federal employees who had A only, and then they turned 70, and now they'd like to get A and B because they want better coverage, right. And now they're going to have a 50% penalty for the rest of their life. And sometimes now it's cost prohibitive. So I think it's wise to have A and B. I do. I think that's smart. And then you're going to have to decide, do you just want Blue Cross Blue Shield to be in the second payer position? And some people choose to do that. Other people, what they're doing is they will get what is called in an MA only plan. That's called a Medicare Advantage only. They keep their Blue Cross Blue Shield plan, and Blue Cross Blue Shield will coordinate with the Medicare Advantage plan. You still get your meds through the Blue Cross Blue Shield system, so you don't have to have a Part D plan, but you get an MA only plan, and then you can get all the perks and benefits that come with that MA only plan, and that Blue Cross Blue Shield will coordinate with them. So there's lots of people that are doing that today. Now, the other option you have, I would tell you it's not quite as popular, and that is that there are people that actually will just suspend their FEHB benefits, suspend it. I wouldn't terminate it. That's one of the reasons I discourage people from getting on supplemental plans if they're with the federal government. They have FEHB because you have to fill out paperwork terminating FEHB, and that's permanent. I don't really like that.
Yeah.
But you have the option to just suspend FEHB. You can get a normal marketplace Medicare Advantage plan, MAPD, including prescription drugs, at a zero premium. And then if you change your mind down the road during a Medicare open enrollment, you can go back into the federal system. Right. And so I like that option.
Yeah.
I think they're both good. And if you decide neither one of those are for you, have A and B, have Fed Blue in the second payer position. You're still going to have to pay a premium for that, of course, but not bad.
Every person's situation is different when it comes to having that Fed Blue policies as well. Because some people's premiums are a little bit higher when it comes to the Fed Blue plans as well, and it might make more sense to move over into a supplemental plan.
Yep.
Some folks it does, some folks it doesn't. So
yeah.
it really just kind of depends, and really each person's situation is unique when it comes to a lot of that stuff.
That's so true. It depends on your premium.
Oh, yeah.
Because we do see, and I think it varies with what branch of the government you
Yeah.
served in. I think
Generally.
is what happens. So, anyways, that's our 2 cents on that one, David.
All right. So Margie.
And by the way, he said, "What's Medicare going to cost? It's going to cost what everybody pays for it. Your Part B premium, $164.90. If you're married, if you're above $194,000, you pay extra.
Yeah.
So I'm not sure where your income is, but A is free, A is zero premium, B is the cost.
Yep, absolutely. Okay. Perfect. So Margie here, I turned 65 in February, plan to retire June of that year, so next year. Work as a teacher. I'm in an HSA. I plan to stay with the company policy until the retirement date. When should I apply for Medicare?
Okay, very good. I understand. So she's going to be in an SEP for sure. So you're 2, February. I'm assuming your birthday's not on the 1st, okay, because then we're going to be off a month. So we're going to say February was your month, March, April, May. So she's down here.
June 30th is the last.
So she wants to start your coverage in July.
July 1. Yep.
Okay, very good. So what I would do if I were you is, hang on just a second, March, April, May,
And June.
and then we have June here.
Yep.
Okay, I don't like to do anything real last minute, Margie. So if it were me, about the longest that I would put this off for, of course she's going to be in an SCP, so she can't do it until June.
Yeah, sure.
Okay, but she can do A only. Okay, so here's what I would do if I were you. You're going to come into Medicare using a special enrollment period, and you qualify for that. And if you don't waste any money, what you can do is you can apply for the latest date. I would have you apply for Medicare A only, would be in the month of May. And if you work with us, we're happy to do this for you. If you do it yourself, just go online and apply for Medicare A only. And when they ask you for do you want Medicare B in May, you want to say no. Just say no to the question. And when you do that, there's going to be a little warning sign come up saying, hey, are you sure you don't want to start B? You're going to be penalized. Don't worry about the warning, okay? Just do A only. And then what I would do is fill that out, and then you're going to, on your own, or have us do it for you, we're going to fill out the 40B form, and all this is done right the first part of June, not before. And those two forms, L564 from HR, 40B form from you or us, requesting a Medicare Part B effective date, July 1 of 2024. That when she said she needs it, right? Good. Mm-hmm. And you're going to submit that paperwork during the month of June, requesting a B date of July 1, and that'll go down very smoothly. Now, here's the deal. You say you have an HSA. So let's back up the clock. If we do this in May, 1, 2, 3, 4, 5, 6. So 5, so 1, 2, 3, 4, 5, 6. So 4, 3, 2, 1, 12, 11. I would tell you that I think your safest bet is to, after October of this year, I wouldn't put any new money into your HSA. Okay, so after October. Now remember, you can put in almost $400 a month by the time you do the normal contribution plus the catch-up because you're over 55. So you're eligible to put in right about real close to $4,000 for the year of 2023. But I would stop contributions after you've made that contribution in October, because I think you're going to have an A date. Excuse me, I think you're going to have an A date. September. Yeah, right around there, October range. No new money going to your HA is the point, because they backdate the A date from the date you apply. And so the longest I would advise you to put this off would be the month of May, apply for A only, and then in June, L564 is dated, 40B is dated, and then filled in and sent into the local Social Security office for a July 1 effective date on B.
Yep.
That's the way I'd set that case up.
Yep, very good. All right, so the next one here from G. If your Medicare Advantage carrier pulls out of the state, or you move to a state that does not have your Medicare Advantage carrier, can you then choose to go back to regular Medicare with a supplement plan?
Go ahead.
You cannot.
Yes, you can.
You can.
That's all right. Yeah, you can.
Well, these are, I guess, a little too. Anyway,
Well,
continue.
that's right. That's
Yeah,
right.
let's
Okay,
touch on it.
and you move to a state that does not have it, then yes, that would be a
GI.
true guaranteed issue
Yes,
product.
it
Yes,
is. Okay.
you can. And so in most states, again, it's going to be based upon your birthday. So you're born after January 1st, 55,
Mm-hmm.
then you're going to move to a G plan. Okay, and remember what I said earlier. That's that 3% of the business, right
Exactly
there.
right.
Okay. Now keep in mind, let's say you decide I want an N plan. Well, then you can apply and go through underwriting. But if you can't get through underwriting, then you would qualify for a supplemental plan G or F, depending on your birthday.
Right.
Okay, it is a guaranteed issue.
That's right.
You have to. By the way, you have to do that. I think within 63 days. I wouldn't wait that long. But
Yeah.
I think once you've lost that coverage.
It's relatively quick. So, all right, Sandra, my husband works for the public sector, and we get HC for life,
for life.
but he is a retiree. I don't think we'll be able to get a supplement plan, as the agency would migrate to enroll us into a Medicare PPO plan.
More with a question?
That's all that I've got there. So essentially, I don't think we'll be able to get a supplement plan. So essentially, going through the healthcare for them, they only offer the Advantage policies. So
Yeah. Yeah, and that's very common today.
yeah,
Most companies, they're gonna push Advantage plans, and so, and really, Sandra, if you're happy with the plan, these are called actually they're different than normal Advantage plans. They're called waiver plans, and I've seen some attractive ones. I have. And if it looks attractive and you're comfortable with the issues with Advantage plans, networks, pre-authorizations, permanency, if you're comfortable with all that, then go for it. If you say, no, I don't like that, I'd rather go to any doctor that takes Medicare and I don't want pre-authorizations, then you can always get a supplemental plan. And remember, folks, listen, these supplemental plans are not going to break the bank for most people.
Yeah.
Average premium right now on a G plan is what, $125 a month, something like that?
Yeah.
You have a drug plan for another maybe $25, so we're only talking $150 a month for Cadillac insurance. Being able to go to any doctor you want to go to. Your max out of pocket is the deductible $226.
Yep.
So as long as that's in the budget, listen, this is an area I wouldn't cut corners. You were talking earlier about worst case. Listen, we see the worst case every day.
Yeah.
Yeah, we hear the stories, and it's sad when people are disappointed with their coverage because now they can't get a knee replacement. Folks, I can't tell you the times I've had people want a knee replacement, Advantage plan wouldn't approve it. They said, no, go to therapy. Let's get shots in the knee. They just don't want to pay for that. How do you think they make billions of dollars? Yeah. It's not because they're benevolent. It's because they at times limit services, and that's frustrating. As long as you're healthy, you'll love your Advantage plan. You go through a serious health issue, you may probably fall out of love with that plan. That's the norm.
Yep. All right, so next one here. I am a veteran and I have VA health insurance and health problems. I'll be turning 65 in April. Will I be able to get a supplement plan, and how will this affect my VA health insurance?
Yeah, won't affect your VA whatsoever. Those are two totally separate plans.
Yep.
You have VA because you served in the military. You can use that system and use their doctors and their rules and their hospitals. You can do everything they want. And if you want a civilian option, then you can enroll in A and B and get your supplemental plan. Then you have the best of both worlds. You can choose whatever you want. And if you have health problems and you're concerned about the VA system, then I definitely would be getting a supplemental plan because remember, unless you live in New York, Connecticut, Maine, or Massachusetts, you only have 6 months prior to your B date or 6 months after to get that supplemental plan. And so I'd be getting on that. Now, I will tell you this. We have people that are healthy and love the VA system.
Yeah.
Then a lot of them don't get SUPs. They get the MA-only plans. So they have a civilian option, but because you have health problems, I believe it'd be best to go ahead and get that supplemental plan. Unless you said, hey, I love the VA. I think it's always going to be there for me. I can trust them and all that kind of stuff.
Yeah.
Because if they change the VA system and you're beyond your 6 months of your B date, you cannot get a supplemental plan with health problems.
Yeah.
So-
And and we see that too often where we make the decision too late. We have the question later on. It's like, well, if had we talked inside of that enrollment window, then yeah, we would have been
right.
somewhere fine.
That's right.
But yeah, those are like you said, mutually exclusive essentially. you still have that same option for a supplemental policy if that's what you're looking for.
That's
so.
right. Yeah. They're two different government agencies. So VA is not going to bill Medicare. Medicare is not going to pay VA. It doesn't work that way.
Right.
So when you get that supplemental plan, it's going to coordinate with Medicare.
All right, so the next one here from John. Which states have the best supplemental plans and premium cost?
Wow.
So the plans are standardized across the board, so really there's not a whole lot of difference there. There's no difference. You only have to say not a lot. Well, from what I remember when it comes to premiums, North Carolina, South Carolina were real good.
Arizona is very good. Texas
Yeah.
good. Really, most states are really good. Anything in the Midwest, South, Southeast, and Southwest are attractive. When you get up in some of the states, if you were in New York,
Northeast.
I think right now in New York we write more N plans than G
Yeah.
plans. I think that'd be true. I think in Florida, when people get supplemental plans, we write more N's than F's. G's. So there are a few states where
There's still a lot of G's in Florida, though.
Oh, there is?
still.
Okay,
Yeah.
okay.
It
Go
just
ahead.
kind of depends. It varies as you go through some of that stuff. But for the most part, the states where you're going to have kind of like we talked about more guarantee issue rules, the premiums are going to be higher because essentially the insurance companies do have to offset for people changing those policies if they do have health conditions like later in life. But for the most part, they're relatively fairly stable. I'd say average cost for a fella is about $140 to $150, $160, and then for ladies, I'd say $20 less, $120 to $140. And I'm probably being over.
that's broad. It's broad.
That's extremely broad. But for the most part, it's really fairly standardized.
But also, John, you can't get a supplemental plan where you don't live. So maybe you have some options. Maybe you're thinking about retiring somewhere. Then I think that's a very good question. Where if you have some different options. But definitely, if you're going to retire in Texas, Arizona, those rates are wonderful in those areas for sure. And Garrett did make a good point. Whenever you move to a birthday rule state where companies have to take you, during that window with no underwriting, those states tend to have a little bit higher rates because those insurance companies have to take on additional risk, so they build that in the premium.
Oh, for sure.
Yeah. So good point. All right, John. Hope that helps.
Yeah. And so a NERB. Spouse successfully appealed 2023 IRMA last March. Can I use this appeal approved letter to appeal my IRMA when I turn 65 later this year as we file jointly?
Okay, let me tell you, you can't use the same form, but you can use the same information.
Yep.
So because you do file a joint return, that spouse's life-changing event, your numbers are all the same, so you'll put the same information on there, but it's obviously going to be your Social Security number and your signature on there. Same info, different form, so you wouldn't just copy and send it in, and you're probably saying, well, that's obvious.
Right.
But I want to make sure you know, same information, it's fine.
Yep. Yeah. Last one here for us. We're gonna finish up here on this one. So, how far in advance would you do any medical screening before the underwriting policy for Medigap plans? So essentially,
Oh, okay.
yeah. So how far in advance would you be answering those questions?
I don't understand the question.
So no, it's all right. So essentially, whenever it comes to going through the underwritten process, you're going to do that. It generally takes about 7 to 10 days before we get an answer back from the insurance company when it comes to underwriting.
Oh, I
that's
see.
essentially the basis. Of the
Okay,
question.
yeah, very good. Yeah. So once we have had a conversation with you, we answer the questions, you're right. We'll have an answer from the insurance company, usually sometimes it's immediate.
Yeah.
Yeah, we have
Sometimes
immediate underwriting day with some carriers. Now, if they see a medication or there's something, they're uncomfortable with your answer, then they may take a week or 10 days, but that's about it. So here's the way that works. I think so. Let's say if you said, "Hey, I want to go effective 10/1," well, we'd be doing that right now. But if you're not going to start a supplemental policy until February, then I would wait until within about 60 to 90 days before the policy effective date before we started that process.
Yeah.
Okay.
Generally, what your kind of rule of thumb when it comes to anything Medicare related is about that 2 to 3 months in advance. It gives you plenty of time. That way, there's really no hiccups along the way, or if there are hiccups, there's plenty of time to pivot.
Right.
But really, they do go off of application date whenever it comes to a lot of this stuff. So if you needed something to be done next month, once again, they may backdate it, but then if we're changing policies, going through medical underwriting, we're worried about drug plans and all this other stuff. But as a safe time, I would say at least probably 60 days in advance is going to be a safe window for you.
Yeah, that's plenty. I would add this to you, though, because I don't know your situation, but if you have to go through underwriting, and let's say you're right now in the midst of getting physical therapy, don't apply. because that's going to be a question they're going to ask you. If you're in the midst of physical therapy, you have to make sure that therapy is completed.
Right.
If you've had cancer in the last 18 months, it wouldn't apply because you're not getting approved.
Right.
Yeah, so we have look backs, and a lot of these questions are time related. But if that's not an issue, then we're just generally saying, when do I apply? 60 to 90 days is perfect.
Yep.
That's right.
Yeah. Very good.
Okay, are we done? Okay, well, hey, I want to thank you all. Just keep this in mind. We are Medicare brokers, and we would be delighted to help you if you need something beyond this. And so you see our 800 number, you can call us. I want to make sure everyone knows that as brokers, we are not beholden to any insurance company. We write for lots of them. I don't think there's anyone that writes for all of them. That'd be pretty impractical, but we write for a lot of them. I guarantee any carrier that you would know of, we write for. And we take the time to be thorough. We want to look at the companies, rates, stability. If it's Advantage, we're going to check networks. We're going to do everything we can to make sure that you have the right plan for you. We don't pressure you. We're not biased. We really are not. And our services are free. And we will do everything for you that you ask us to do. Some people want us to set up an SSA.gov account. We're happy to do it. Enroll you into Medicare. Certainly talk about all the insurance plans. We take care of all the enrollment. And then lastly, we have a customer service team that's right here in America. One of the frustrating things to me right now is all these people are sent for customer service to China or the Philippines or India. And nothing wrong with those people working there. Sure. But I'm telling you, for these insurance companies, they make billions. And now they send you overseas, and you have to talk to somebody that sometimes you can't understand, and they don't understand Medicare. Yeah. And that, to me, is frustrating. So we are U.S.-based. You come right into our home office. People that I personally have trained, you know that to be true. I train everyone, and they'll take care of you. So we're totally free to you. There's no extra cost, and we'd be delighted to help you and to serve you. So keep that in mind whenever it's time to go on Medicare. And tell your friends about us, if you will, please. We'd be thrilled to help anyone that's ready to go on Medicare.
Absolutely.
All right. Thanks so much.
Yeah. Have a good night.